So as the conflict in the Middle East continues to linger on, what impact has it had with the market? Let's dive in. My name is Brian Cannon, and welcome to Markets in 5. All right, so I'm going to go through 4 charts today that essentially will kind of explain the theory that you really shouldn't be worried about this conflict in the Middle East. So the first chart here is our typical S&P 500 on a daily basis. So you can see that in prior Markets in 5s, I kind of talked about this consolidation zone where we had the bulls and bears kind of tug of war with each other. Well, the bears ended up winning, and then they took out the 200-day moving average, which is significant in the world of technical analysis. That basically tells you that you have to start looking for a bottom. But it quickly kind of came up and tested this resistance zone. So anytime you can't get above a range, it's very significant. And then basically it just jumped above it, and not only has it broken this downtrend, it in the meantime took out the 200-day moving average. It also went above the 50 and the 20-day moving average. So that's all very significant. And essentially, as of trading day yesterday, it actually broke out and created an all-new high. And so RSI, obviously, while the market was struggling a little bit, was down, and it's since popped back above 50, and actually it's getting to the point where it might be a little overbought. So I would anticipate this market to continue to run a little bit, and then more than likely come back and test this breakout line right here, and look to maybe test that on the downside. Assuming that holds, then we would anticipate further gains in the market. So as of now, again, the war has had very little impact aside from just a V-shaped recovery. All right, so this next chart is the relationship between high yield bonds and the S&P 500. So going back to this prior pullback, you can see that the red here is the S&P 500, the blue is the high yield. And then you can see this black line at the bottom chart is the relationship between the high yield and the S&P 500. So it's not to say that you go into high yield when the market's dropping, but what it's saying is that when the market drops, high yield drops as well, but it drops less. Okay, and so you can see that the relationship or the relative performance of high yield outperforms the S&P 500 in a downswing. So if we take that, fast forward it to today's pullback from the war, you can see that, obviously S&P dropped down and high yield dropped down as well, but you saw that high yield outperformed the S&P, okay? So what that tells you is now that is reversed, it's telling you that now S&P is now recapturing outperformance relative to high yield. And so, again, what this tells me is that this conflict is more than likely over, and we're back to business. All right, here's another chart. This is the equal-weighted S&P 500 relative to the cap-weighted S&P 500. So what's the difference? Equal-weighted, so with the S&P 500, as we look at it, as most people consider it, the index is a cap-weighted index, meaning that the top 10 stocks make up literally 40% of the overall performance of the S&P 500. So that's the cap-weighted. The equal-weighted means it takes all 500 positions and equally weights them. And so what this information tells you is, are the top stocks in the S&P driving the performance, or are other stocks driving the performance? And so when this relationship heads down, this means that the S&P cap-weighted is outperforming the S&P equal-weighted, meaning that it makes sense to be concentrated in the largest stocks within the S&P 500. And so as an example here, going back to 2022 when the S&P 500 was down roughly 20%, you can see that the equal-weighted performance outperformed the cap-weighted performance, meaning it made sense for you to spread your risk around a lot more companies. And then essentially when the market began to take back off in 23, you can see then it made a lot more sense to concentrate your positions in the top 10 stocks of the S&P 500. And so that relationship continued to linger down. Now, as a result of this conflict, you saw it start to take off and really catch wind and even break out a little bit. But since that V-shaped recovery, you're seeing this relationship drop, meaning, again, it makes more sense to have your assets more highly concentrated in the largest stocks. Okay, in the final chart here, this is the S&P 500 on a weekly basis. So what this does is this takes some of the noise out. So it smooths out some of the swings, it takes some of the day-to-day gyrations out, and essentially, again, when the S&P on a weekly basis drops below its 50 RSI, then there's blood in the water. There's a little bit of trouble. And so we certainly had that during this conflict. In fact, it came down, it broke the 20-day moving, or the 20-week moving average and the 50-week moving average. And so we were obviously on high alert to see if this thing continues to drop down like it has in the past. But it didn't. It came back up. It recaptured the 50-week moving average. And then as of yesterday, it actually printed an increase above the 20-week moving average. The RSI obviously popped back above 50. MACD looks good. So again, all of these charts go to support the theory that this conflict may not be over, but as far as the stock market's concerned, they're getting back to the basics of looking at earnings season and fundamentals. And so again, I wouldn't worry so much about this conflict anymore. Obviously, we want to keep our eye on the cost of oil and all the other things that can impact the market, inflation and whatnot. But as it stands right now, the coast is clear. Time to not be too conservative. So as you can see, the impact of the conflict in the Middle East has had very little impact to the market. So it's back to fundamentals, back to charts, and back to business as usual. So if you have any questions, give me a shout, and I'll see you on the next Markets in 5.